Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And in tonight's video, we're going to go over all of the trades, opening trades that we made for Thursday, February 26th. So we actually had one earnings trade today. Again, I know they come in sometimes a little bit late, but that's just how we get filled in some of these trades. We did have the working order in Herbalife, which is HLF, first one on your screen here. We did have that working order for about 2.5 hours today at that same price. So it just takes some time to get some fills sometimes, and unfortunately, we obviously get them and send them right out. So I know some people are able to get into them, others weren't. But of course, we have more trades, and again, the whole idea here is that you're trying to learn from some of the trades that we make so that you can make some on your own. So the first trade I do want to go over tonight is the Herbalife trade. It was an earnings trade. We did an Iron Condor in Herbalife. The reason that we did an Iron Condor is because this tends to be a pretty big moving stock, and we don't want to get caught kind of with undefined risk in this type of situation. It's just not what we want to get in the situation of right now. But we did trade the weekly options, which are the frontmost contracts, the 38.40 call spread, so a $2 wide call spread, and the 30.28 put spread below the market, again a $2 wide put spread. And so that gave us a total credit of about 60 cents, which again helps move our break-even point out just a little bit further on either end. So when we actually go to the platform here, before we actually look at Herbalife, even though it kind of started here, I want to take a minute just to tell you why I didn't go with an earnings trade in another stock. So this is actually a look at JCPenney, and JCP, which is the ticker symbol, has earnings as well and was one of the ones that we were looking at. Now, it's got fairly good liquidity. I mean, actually, it's got pretty good liquidity as far as the number of contracts and the bid-ask spread. Everything is pretty tight in JCPenney. So it kind of checks off a lot of those boxes. But in particular, with this type of a trade, you'll notice that the stock closed at about $9.12 or so about $9. And the expected or measured move was about 76 cents. So I always just kind of round up and say, okay, you know what, it's probably about $1 on either end. So if this stock closed at around $9 today, the options before the market closed that were $1 below the market are only trading for about 7 cents. So you can see, again, if the stock closed at around $9, if we want to get about $1 away just to get outside of the expected move, then those options are trading for about 7 cents at the close today. So just really not worth a lot. And again, yes, there's a lot of volume, a lot of liquidity. That's great. But pricing-wise, it barely covers commissions. And for some of you out there who have really high commissions, it's not going to cover any commissions. Same thing on the top side. If we move out about $1 on the top side, and if we could have gone with the 10 strikes, you can see those only were trading for about $10 a piece as well. So it kind of makes sense why there's so much volume and liquidity in here, is because people have to get into a lot of contracts here for JCPenney to make it worth it. It's just not something that we want to do. We want to be trading smaller position sizes, and even though it kind of meets a lot of these requirements, the pricing just isn't where we want it to be. There's no kind of set rule or guidance here on that, but you just have to, be a little bit smart about how you're looking at pricing. And in this case, to do just a naked straddle in this thing or strangle, we wouldn't take in that much in premium to do it, so it's just not worth it. Now, when we go and take a look at the trade that we made in HLF, you can see that it also has pretty good liquidity, even at these far out strikes. Notice that the two strikes that we kind of focused on today were the ones that had a lot more of the liquidity and volume today. So both of these strikes at 28 and 30 had pretty good volume and liquidity. And same thing on the top side of the trade with the strikes at 38 and 40. A lot of good liquidity in both of these different strikes. And very deep kind of markets in HLF, there's not one particular strike that really stands out, but everything was pretty active today. Now, we decided on either end to do what we usually do, and that's go just beyond the expected move. So stock closed at about $34.82, so about $35, and the expected move was about $3.70, so about $4. And so we're just trying to go beyond that expected move on either end, and we just barely got outside of it on the bottom side and just barely are inside of that expected move on the top side. But with our break-even point, we are definitely very, very close to that expected move. Now, the stock did announce earnings, or the company did announce earnings kind of after the market closed, and is trading up just a little bit higher kind of post earnings here. We don't know exactly where it's going to trade tomorrow, but again, our break-even points are all the way out here at 38.60 and all the way down here at 29.40. So very wide, and with the stock currently trading kind of in between this range, it looks like it should be a good trade for tomorrow, but obviously we'll have to wait and see where the stock actually opens up. All right, so the other two trades that we got in today, or the other three trades we got in today, the first one is just a regular debit call spread in BBRY. I really like this trade, not just because I think the stock may be moving higher, that's what some technicals may be showing us, but also because of the pricing that we got on this spread. So we did do the April 10-11 call spread, so we bought the 10s and we sold the 11s, and we paid a net price of 56 cents. Now again, the reason I like this spread more so than just the directional play in BBRY is because we did get a really good price as far as where our break-even point is relative to the current stock price. So here's what you can see in BBRY. Nice move in MACD. It's continuing to move higher. Low implied volatility, which means we have to trade some sort of debit spread or calendar or ratio spread. And so we think, you know what, at some point it may continue to move higher over the course of the next month and a half. So we've got all the way till April, got plenty of time to make some money in this trade. Now what's really good about this trade again is the fact that our break-even point just on the onset is below where the stock is trading right now. So our break-even point is at 10.53, which is right here on the profit loss diagram. When we entered this trade today, the stock was trading all the way up here at almost 10.90. So that gave us an extra 40 cents of room where the stock could actually fall and we still make money. In fact, if you look at it right now, the stock is trading at about 10.76 right at this moment. And so we still have some room between ourselves and the market and our break-even point to actually make money, even if the stock sits here, never goes higher, or actually goes down a little bit. So I like making trades like this where you have just kind of a little bit of an edge, a little bit of built-in security in your pricing, and that's why I went after a trade in BBRY, in addition to the fact that we needed some additional bullish positions in our portfolio. All right, so the next trade that we made was a trade in IWM. Now, IWM is a really cool trade because it has very low implied volatility right now, and so what we decided to do was actually trade it with a calendar and make it a little bit directional. So with IWM, we did the 125 calendar call spread. That means that we are buying the back month, which is April, selling the front month, which is the March, and the net difference between those two is an $85 debit to get into this spread. Now again, when you look at the chart of IWM right now, you'll see that implied volatility is down in the 1 to 4 percentile. So it was actually at the 1 percentile today when we entered this trade, which means it's incredibly low, and it almost assures us that at some point, if we get any sort of hiccup in the next 20 days or so between now and March expiration, that implied volatility will probably increase from where it is right now, which will help this option position that we're getting into. So this spread was a little bit directional. We had to take it just a little bit directional in its view because we already had a position that was a little bit bearish in IWM. We've got a iron butterfly right over the market at about 117. So we've already got a bearish position in IWM. This is what our bearish position in IWM looks like. So we felt that it was okay to take a position that had a window of opportunity somewhere in this range. Again, we've already got a bearish position that's centered over the market at about 117. We can take another bullish position and kind of balance ourselves out here. So this is what the position in IWM looks like just by itself, this call calendar spread. You can see it's definitely a little bit directional. We need the stock to move just a little bit higher for this particular position to make a lot of money at expiration, which is centered around the 125 strike. But ideally what we'd want to see with this position is actually just implied volatility to increase, and that would give us an opportunity to take a very quick profit in IWM just purely based on an increase in implied volatility. And in fact, if we actually get that and the stock moves lower, we'll probably have an opportunity to close both of these trades at a profit. Now, the last trade that we want to go over tonight is our Iron Condor and Rig. So this one's a little bit different because we did an unbalanced or kind of skewed Iron Condor and Rig. Now, Rig already announced earnings, but today its implied volatility still remained pretty high, even post-earnings. So we saw a good opportunity to sell some premium in the market and take in a fairly good credit. Rig's a really good security. It's got pretty decent liquidity, pretty tight markets, and we've traded it before with some good success. So with RIG, we did the 18.19 call spread. That's our $1 wide spread above the market, and then we did a 13.11 put spread. So you'll notice that it's a little bit skewed to the downside as far as risk because we have a $2 wide spread on the bottom side, the 13 to 11, versus just a $1 wide spread on the top side with the 19.18 spread. Overall, we took in a $48 credit. By widening out the put side, that helped us take in just a little bit more in credit on RIG. But again, when you look at a chart here of RIG, you can see the implied volatility, even post-earnings, still remains pretty high. It's definitely heading lower, and the IV percentile is still up at about 63%. And that's just because it's in the oil sector, and all of oil right now is really high implied volatility and pricing. But as you can see, the stock's been moving just a little bit lower here. And so we obviously, took a little bit of a directional play, maybe that the stock actually might move up over the next couple weeks. So here's what our skewed iron condor looks like in RIG. Let me just outline it here so you can see it right on your screen. And you can see that most of the risk in this position is actually just a little bit lower to the market. So we actually gave ourselves a little bit less risk to the top side in case things really turn around in oil between now and April. So we're kind of looking a little bit long term, not just right now. The stock's moving down right now, but over the next month and a half, all the way out through April, where might oil be? And if it does make a huge move higher, we wanted to protect ourselves on this end of the trade. And so you can see that we did that by making our call spread a little bit narrower on the top, just a $1 wide call spread compared to this $2 wide put spread. But right now we've got the stock centered right over the strategy. If we get a drop in implied volatility anytime soon, even if the stock starts to rally, should have an opportunity to close this out at a nice profit early. So as always, I hope you guys enjoy these videos. If you have any comments or questions, please add them right below this video in the comment section. If you're watching this video somewhere else online or on YouTube, you just have to understand that this video and these alerts are sent out to our members, but you're getting them about 15 days after they're sent out to our members. So if you want live, real-time alerts and this video that follows each and every night going through our trades, you've got to sign up for a membership at optionalpha.com. Until next time, happy trading.